they say money won't buy you happiness, but being broke really ain't a good time. So all I want is just to get paid. I know I ain't ashamed of trying to make a wage now. Money, 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 money makes the world go round. I need money, 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 money.
Hello, everyone. My name is Craig Crow, and I am a field underwriter advisor and a financial coach. My credentials are also displayed on the screen. So, today we will be discussing the importance of having a mortgage protection policy in place to protect one of the most valuable assets you will have, which is your home. I will also be discussing the different benefits and advantages that come with having this policy to protect you and your family. So I know that you are probably asking yourself, do you need mortgage protection insurance? Is mortgage protection worth investing into? And what does it protect anyways? So let me clarify a few things for you. Mortgage protection insurance is a type of life insurance designed to pay off your mortgage if you are to unfortunately pass away during the time where you are still making your monthly mortgage payments. The funds from your life insurance policy will be given to whoever you choose to become your beneficiary, and this can be used to pay off your mortgage loan and other expenses you may have and give your family the financial freedom of not having to worry about those monthly expenses. There are also some policies available to cover your mortgage payments for a certain period of time. So, this policy was designed to protect your family from any financial hardships that they may face if you or a loved one were to pass away, and with the financial burden being placed on one person during that critical point in your life, it will give you the help you need to cover one of the most expensive bills you pay, which is providing a home for you and your family. So, this not only protects your family, but it also helps to protect the equity in your home as well. And it also protects your income if you become disabled or unfortunately pass away. It can also be used to protect and grow your wealth and help keep your home and your family after you pass away, and can continue to be passed down to create generational financial freedom for your family. Some of the other benefits of having a mortgage protection policy and achieving a debt free life are: depending on the company that you receive your loan through for your mortgage, they will be able to offer you a lower interest rate on your mortgage payments, and this will help you to save money in the process. This is because the company does not view you as a risk or a liability, because they see that you have the necessary funds to pay back the loan that you received from them, just in case you unfortunately pass away before you are able to pay back the total loan amount that was provided to you. The other bonus option available through other certain types of permanent life insurance policies are: they allow you to build cash value. So basically, a portion of your monthly payments that you pay to receive a life insurance policy are going towards paying out the death benefit your family will receive from this policy when you pass away, and the other portion of that is going towards a cash value or savings account that is built into your policy. This cash value gives you the capability of building your funds at a faster rate due to the interest being credited to the money in your policy, and allowing you to receive tax-free money to do with however you see fit. So, to give you an example, some people pay additional funds on top of the minimum payment required to pay off their debt faster than the time that they were given to pay that debt off, such as with a house, a car payment, credit cards, student loans, and any other type of debt that you may have. You are given a certain amount of time to pay these things off. So, with the certain types of life insurance policies, it allows you to make the minimum payments required, and with the additional payments you make toward being debt free, this will help you pay down the principal amount so that the interest being charged to the account won't keep growing, causing you to pay more than what you originally received, and therefore putting you in more debt than what was actually given to you. So this option helps because you will not be paying any more than what you are currently paying if you are making additional payments already to go towards achieving a debt-free life. How this works is, say for example, you are making the minimum payments required for the debt you have, such as if you are paying $1,400 a month for your mortgage, $400 for your vehicle, $200 for student loans, and $100 for credit cards. So that would be a total of $2,100 per month for this example. So let's say that hypothetically you want to pay off this debt faster than the time frame you were given so that you can put more down on the principal and avoid paying extra with the interest that you will be charged with. So you start paying an extra $250 on your mortgage, $150 for your vehicle, $125 for your student loans, and $75 on your credit cards, giving you a total of $600. So for this example, I will show you what it looks like to pay off your debt the traditional way. So with that extra $600 you are paying, that will only pay off $600 of your debt, and that will be applied directly to the loan and some of the interest as well. If you were to place your money in a traditional savings account, these types of accounts only give you less than a 1% interest that will be credited to the funds in your policy. But this method will take longer to achieve your goal of financial freedom because the interest the company is charging you for the loan you took out is more than the interest being credited to the funds in your policy. For the people that chose to pay their debt off directly to the loan, they will be able to contribute $7,200 for the first year. Then, for the following year, they would have contributed a total of $14,400. What I love about interest, especially compound interest that is in your favor, is that your money makes additional money for you. This is the fastest and smartest way to use money for the tool that it is. So let's learn how to make our money work hard for us instead of us working hard for our money. Now, with the traditional savings account, keep in mind that you receive less than a 1% interest rate with most banks that will be credited to the funds in your account. But for this example, I will just leave it at a 1% interest rate that you will gain each year. So for the first year, you have a total of $7,200 in your account, and with the 1% interest rate being credited to it, you received an extra $72, giving you a total of $7,272. So for the next year, you have a total of $7,272 already in your account from the previous year being added to the second year amount of $7,200, giving you a total between the 2 years of $14,472. Now, we are going to credit these funds with a 1% interest rate, giving you an extra $144.72, giving you a grand total between the first and second year of $14,772. $616.72. So, with the traditional method of paying your debt off directly to the loan for a 2 year time span, you are only able to contribute $14,400 to go towards the principal and the interest of that particular loan. Using the traditional method of using a savings account to pay off your debt directly to the loan for a 2 year time span, you are only able to contribute $14,616.72 to go towards the principal and the interest of that particular loan. With the next example, I will show you the benefits of using a permanent life insurance policy to achieve a debt-free life. So with the extra $600 you are paying to get out of debt sooner, the interest rate we will be using that will be credited to the funds in your policy. For this example, we will be using a 3% and a 12% interest rate, allowing your money to work for you and grow at a faster rate and allow you to achieve a debt-free life sooner. So for the first year, you have a total of $7,200 in your account. And with the 3% interest being credited to it, you received an extra $216. Now, with the 12% interest being credited to the $7,200, you received an extra $864, giving you a total of $7,416 with the 3% interest and a total of $8,064 with the 12% interest. So for the next year, with the 3% interest rate, you have a total of $7,416 already in your account from the previous year being added to the year two amount of $7,200, giving you a total between the 2 years of $14,616. Now we are going to be crediting these funds with a 3% interest rate, giving you an extra $438.48, giving you a total between the first and second year of $15,054.48. So for the next year, with the 12% interest rate, you have a total of $8,064 already in your account from the previous year being added to the year two amount of $7,200, giving you a total between the 2 years of $15,264. Now we are going to be crediting these funds with a 12% interest rate, giving you an extra $1,831.68, giving you a total between the first and second year of $17,095.68. Using the life insurance method to pay off your debt directly to the loan for a 2 year time span with the 3% interest rate, you are able to contribute $15,054.48. And with the 12% interest rate, you are able to contribute $17,095.68 to go towards the principal and the interest of that particular loan. So as you see, there is a dramatic increase in the funds you can contribute to pay off your debt to achieve financial freedom. There are many different methods you can choose to pay off your debt as well. Some people prefer to pay the highest amount of debt that has the highest interest rate and then move on to the smaller amounts of debt. And some people prefer to start with the lowest amount and grow towards the largest amount. Either way, using compound interest to pay off your debt is the best method to cut back on the negative interest that causes you to pay more than what you received from the original loan. The interest being credited to your funds in this policy can be set to a level interest rate or an index interest rate. but still gives you a greater advantage of achieving a debt-free life sooner than traditional methods. This policy allows you to receive living benefits such as critical, chronic, and terminal illness riders. It also allows you to receive a death benefit to cover your family to be protected from natural and unexpected deaths. By using the permanent life insurance debt-free life method, this will allow you to become your own bank as well. After your debt is paid off, you can continue to use this same method by continuing the payments you were previously making to achieve a debt-free life and capitalize on the tax-free funds and compound interest. You will also have access to be able to purchase more assets to create multiple streams of income or for you to live the life of financial freedom you always desired to have. There are many other riders that can be attached to your policy to protect your family, and some policies that can be acquired separately. Some additional riders consist of critical and chronic illness, and a few illnesses that are covered by this are shown in the picture. There are also some policies that will cover your income with the disability income rider that provide an extra layer of financial protection by replacing your income when you are not able to work due to a disabling injury or illness. The last rider I will share with you is a terminal illness rider, and this allows for an early payout if you are diagnosed with an illness and are expected to pass away within 12 months. This will allow you to set your financial affairs in order with access to your death benefit before you unfortunately pass away. Now, being a homeowner is a big milestone to achieve in life, and there are different advantages that come with owning a home. It can allow you to use your own home as your bank as well. This can be achieved with something called equity, and I will explain what that is and how it works. An example of how equity works is if your home is worth $300,000 and you have a mortgage balance of $150,000, then you would have an equity value of $150,000. So basically, equity is the value of your home and the amount that you actually own that has been paid off through your mortgage payments minus the amount that you still owe before your home is paid off entirely. Like I stated previously, you can use your home as your own bank to purchase things like home renovations, education costs, wedding expenses, or other investments that can create multiple streams of income. This is why it's so important to have a mortgage protection policy in place because the equity in your home will be protected with this coverage. The mortgage protection policy also allows you to keep your home in your family for future generations, and I will explain why this is a great asset to keep. In this picture, it will explain why having home ownership will contribute to your family's future wealth and why real estate is a great asset that builds generational wealth. And another thing that helps with this process is something called appreciation. So, what appreciation is and how it can help your family with the property that you own. In real estate, the term appreciation refers to the increase in a value of the property or assets over time. This may be a result of inflation, increased job opportunities, and developments in your town. One benefit that can be used with building your home equity, like I stated previously, is home improvements. This can be increased with the value of your home. The increase in value over a period of time can lead to the owner making a profit if they choose to sell the home, or the best way, in my opinion, it can stay within the family and can be rented out to other tenants. This will allow you to keep the home in your family and create a foundation of generational wealth. You can also make more upgrades on the house and build the appreciation or value of your home, which will allow you to pull out more funds through the equity you have built up. Now, for the next example I will show you is for a non-tobacco user that is healthy that would fall into these particular age groups. Now, keep in mind, there are products available for a cheaper monthly premium price and some that are higher depending on your age and your health. So, for this example, say for instance, your home is valued at $300,000. This illustration is showing you the payments that you would make to protect the full amount of your mortgage. And this can provide less of a financial burden for your family in your absence. It also covers your life from unexpected and natural causes of death for a 30-year time frame. For a 21-year-old woman, the monthly premium will be $53.67. For a 21-year-old man, the monthly premium will be $56.60. For a 31-year-old woman, the monthly premium will be $71.02. For a 31-year-old man, the monthly premium will be $75.29. For a 41-year-old woman, the monthly premium will be $139.64. For a 41-year-old man, the monthly premium will be $149.52. For a 50-year-old woman, the monthly premium will be $309.19. For a 50-year-old man, the monthly premium will be $329.21. There are also some plans that come with a return of premium rider. What this means is, although you may lose the coverage for the term plan after it has expired, you still receive all of the money back that you have paid into the policy. This, in my opinion, is one of the best options to have because you don't lose a return on your initial investment. Also, there are other riders that you can attach to your policy called the paid up addition rider. And what this does is, after the surrender date has passed, it gives you the option to be able to cancel the policy at any time to receive all of the money back you have paid into it, or give you the option to receive a death benefit instead. So the next example that I will be showing you will be the numbers for a partial payoff of your mortgage. So for this example, if your home is valued at $300,000, we are going to show what $150,000 of coverage will look like. This also provides coverage from unexpected and natural causes of death for a 30-year time frame. The numbers shown are for non-tobacco users that are healthy for these particular age groups. But before I cover this, keep in mind that there are cheaper monthly premiums available, but it all depends on your age and your health. For a 21-year-old woman, the monthly premium will be $29.50. For a 21-year-old man, the monthly premium will be $30.97. For a 31-year-old woman, the monthly premium will be $38.18. For a 31-year-old man, the monthly premium will be $40.32. For a 41-year-old woman, the monthly premium will be $72.49. And for a 41-year-old man, the monthly premium will be $77.43. For a 50-year-old woman, the monthly premium will be $157.26. For a 50-year-old man, the monthly premium will be $167.28. I would like to thank you for taking the time to educate yourself on the advantages of the mortgage protection policy. And if you would like more information on the different life insurance products and how they work, on the screen, you will see different social media platforms that are available to you to receive more information on all the things about life insurance. Always remember that knowledge is power, so never stop learning. Try to learn something new every single day. And feel free to share this information with your friends and your loved ones. And if this information was valuable to you, please don't hesitate to share and like or follow for more content about all things about life insurance. Until next time, everyone have a blessed day. At the top right of this flyer is my name, my contact information, and the company's website for you to check out everything regarding different policies and to get a better understanding of the company itself. The scheduling information is to schedule a meeting with me so that we can customize your portfolio and to start protecting your life's journey by creating generational wealth, or I can help by answering any questions you have. Just simply enter the scheduling information link into your web browser. This will bring you to a Calendly website that will allow you to pick any date and time to schedule a meeting with me. As you can see, life insurance is not just death benefits, it provides living benefits as well. It also provides coverage for three categories of life's journey, such as your life, health, and wealth. So contact me if any specific policy sticks out to you. We can discuss it in more detail and customize your portfolio to fit your specific needs and budget.